Good afternoon, everyone, and welcome to our final session of the Elire Treasury experience. We're going to be ending on in-house banking and managing organizational finance structures with Elire Senior Consultant and Certified Treasury Professional, Dayton Paul. A few quick final reminders. Attendees have been placed on mute for the presentation. If you have any questions, please submit them in the chat to panelists or in the Q&A portal, and we'll answer them at the end of the presentation. This session is available for 1 CTP credit for attending the full 55-minute session. There will be a link at the end of the presentation to the CTP exam, as well as we will be sending it via email with a PDF of the slides. We do have a few wrap-up items as well at the end of the session in terms of when recordings are going out, etc. So be sure to stay tuned until the end here. With that, I will hand it over to Dayton.
Thanks, Jordan, and welcome everybody to this afternoon session. I'm glad that you could join me for what I think is quite an exciting topic as we talk through all things in-house banking this afternoon. So as we kind of launch into just some topics around what we're going to be discussing, let's hit this agenda and take a look at all the material that we'll be running through. So we're just going to start with the general in-house banking overview, what in-house banking consists of, what it means, what its constituent components are, really just kind of a generic look at all things IHB. Then we'll take a look really a little bit more into the weeds. How do we design an optimal in-house banking structure? What are some key considerations for our organization, especially when we look at organizations of different size and scale? You really got to understand certain constraints to really place an optimal in-house banking structure into your system and really be able to get some of those key benefits. As we talk about that designing, there's some obvious cornerstones that we'll need to take into account when we're looking at implementing in-house banking. We'll talk about a few of them. Some of the biggest ones and most key ones are the strategies that are centered around centralization and managing it at a level that's high enough to really get all of those core benefits and informational availability that really makes in-house banking a great addition to a treasury management system. We'll talk in general just around some of the implementation strategies, some of the things that Elire has seen in the past and some of the challenges that we've overcome to really be able to implement effective in-house banking strategies for a lot of our clients. Then we'll talk about all the benefits that you can really get from that optimized well-designed in-house banking structure and how it can really create a lot of value for your organization and for Treasury as a whole. So that's a little bit about the agenda, just a little overview of Elire. We're celebrating over 15 years in business. Some of the key cornerstones just around Elire in general is we really see ourselves as a trusted advisor to all of our clients. And we really focus on partnering effectively for any implementation of any software, focusing on the people, not just the processes or the things in the system that you might think are the key cornerstones of an implementation offering. We'll mirror some of the discussion today with IHB around that, how it really benefits the people, not just the organization, and how it can make treasurers' lives a whole lot easier. Some of the Elire Treasury practices, just to cover at a high note, and we'll talk through some different impacts from IHB from these areas as well, but Treasury Advisory Services. We have general implementation services, as well as those cloud implementation services and TMS managed services. This is just a nice cloud of all the clients that we've worked with. Quite a few of these, we've developed at least a local in-house banking strategy, but there are quite a few that we've also developed global. So we'll talk about at a wide scale what those differences are, some of the clients that we've seen with some larger in-house banking initiatives, and some that are really closer towards managing different business units under cost centers and material that is essential to just regional reporting and management of finances. In general, our IHB experience extends across industries and across the world, consisting of different players in US-based utilities markets, insurance companies, reinsurance companies, as well as healthcare companies and hospital organization structures. We'll talk a little bit too about some of the global things that we've seen with particular our hotel chains and consumer goods but we've also worked with global organizations in the securities and real estate and auto manufacturing realms as well. So we'll touch on a little bit of the differences and nuances between the different organizational groups and the different companies and areas that Elire has worked with for IHB. But that's just at a high level, some of the differences of organizations and industries that we've worked with for implementing in-house banking initiatives. So with that, let's really take a look at what in-house banking means. What are some of the key things, key items and terms to be aware of and to know when you're looking at really designing and then going and pursuing those key cornerstones for an IHB initiative. Really, when we're looking at the organization as a whole, not really the nitty-gritty technical configuration items, but the organization, there are always three organizational items that we are sure to link up, understand, really get a foundational experience of, and really understand how they're interacting at a given time frame before an IHB implementation. So those three constituencies that we really think of in terms of IHB implementations are going to be the corporate treasury, and that really consists of anything from the CFO, treasury technology, macro level hedging for any interest rates and FX derivatives, and we might have general bank relationship management and making sure that we are keeping strict levels of either debt covenants or other contractually agreed to obligations, well managed and well understood. There's also the regional treasury teams, which are really just the regional organizational business unit management of cash positioning and liquidity in general areas, regions, or countries. And then, of course, your in-country operational kind of planning, making sure that you have forward-looking liquidity purposes and making sure that all payments are processed well and all the technology in country is working and the banking relationships are managed well enough for all of our regional vendor payment requirements, which we'll talk about a little bit more when we get into things like payables netting and the in-house banking's ability to assist for things like intercompany loans and cash pooling and general investments and derivative items. The other key piece, which is really where we can kind of think of the bulk of IHB really living for those larger organizations, we really think about international treasury. So those are the individuals, particularly in circumstances of multinational in-house banking structures in the Netherlands or in Luxembourg, typically, that are really maintaining our cash pooling structures. The international liquidity and investment guidelines that are set by the organization as a whole are typically managed by international treasury as well. And that kind of boils into some of the pool FX hedging and FX management for all of our currencies. In particular, since with things like netting and additions to in-house banking structures, we can see quite a bit of different currencies moving around in different settlements between different business units and companies that really make understanding and knowing where your FX positions and hedging are incredibly important. When we have all of those beautiful things in alignment, it really gives an incredible amount of supervision to all of our cash pooling activities. So any transactions to the cash pool, any legal audit mandates for particular countries participating in either cash pools or even in a lot of circumstances, investment pools to get the return of scale investments instead of just typically having to invest in smaller derivative instruments or things of that nature. It also allows us to standardize things like our market rates and the global intercompany settlement of all of our financial transactions. From there, international treasury typically also manages your international cash forecasting, any payment on behalf of for smaller companies and regions, and then of course, any multilateral netting process that comes into play when we discuss international treasury and in-house banking and material like that. So those are the three core areas. All are incredibly important. All are key pieces to designing and implementing your IHB. And typically what that looks like just on a global aggregate scale, when we're looking at some of those larger organizations, is usually a domestic treasury authority in the United States, and then one in particular in this circumstance in Luxembourg, but the Netherlands with the tax benefits and legal requirements of those two countries. Those are the two most typical that we see in Europe, especially since when we have a lot of presence in Europe, it makes settling things through the in-house bank so much easier through the utilization of things like SEPA and even regional domestic ACH settlement authorities in individual countries. Beyond that, we also see our regional treasury centers represented quite well. So not only do we have, the typical ones in the US and in Europe, but also if we have operations in Hong Kong, Seoul, Tokyo, we'll have typically a regional authority in Asia or Australia, and then typically one in Africa and South America as well. Seeing more and more pop up, particularly in the Middle East, as a regional treasury center as well. So there's definitely fluctuation. This is not a one size fits all. It's very flexible for any organizational size and need. Not only this, but it can be single country. You don't have to be a global organization to get all these benefits that we're going to talk through. And we'll kind of pinpoint the ones that are really more scalable, but there are also some that really benefit an organization of every size and need, and we'll call those out as well. The core makeup of IHB, so what are we looking at? What are the terminology? What are all the accounts? What does it really mean to build out an IHB and a treasury management system? Well, it all starts, of course, with your internal banking structure. You have to have a sound internal bank set up, typically under the international treasury facility, and typically we can also see an additional internal bank set up for things like we had just talked about, where we had that domiciled treasury authority in the US and then in Luxembourg too. So that's one piece of it. There's also, of course, our internal bank branches and internal bank accounts, which are key components of actually being able to manage regional accounts and fund transfers, especially from an IHB perspective. So it very closely mirrors what you typically think of a bank branch external account setup within a treasury management system as well. It's just more focused on the intercompany side, on the real in-house material, and they won't explicitly remit payments out of the system unless there are some material that we're going to talk through here in just a second. So the other side, of course, is all of our external bank relationships. To actually facilitate the movement of money, we have to have our external banking partners, external banks, branches, and accounts. The way that we really link those two up, we say, well, for this particular region, this particular treasury authority, or this particular business unit in country that is participating in the IHB has an in-house banking account. They are tied to external bank accounts in that region or area based on what we call current accounts. So our current accounts allow us to actually utilize the IHB to shrink the number of transfers that we're remitting, consolidate them, make sure that we are only moving funds when necessary to reduce all of our sort of fees that we think associated with wires or even ACHs. So the current accounts are the ones that are actually facilitating the movement of money when we have to move money for cash pooling purposes, investment purchases, or material of the like. Some of the key goals of in-house banking, of course, are some of these key operational measures that we have listed here on the screen. So we just talked about one, the first one being the reduction in transfer quantity and fees charged by all of our banking partners. Since instead of paying a $5 invoice, for example, in netting, and then a $7 invoice going back the other way, we can just consolidate and do a $2 transfer, a single transfer, already cutting our fees in half. When we're talking about hundreds of thousands or millions of dollars moving every day, especially in large quantity, either for cash pooling payment purposes or for maybe intercompany loans, we're looking at a massive reduction in the fees that were being charged just by our banking partners as a whole. One of the other great things that we really get from the cash pooling strategy and making sure that we're collecting excess funds is now we can do things like overnight or short-term loans to any of our companies that need it for operational purposes in the short term. So that is a great structure that allows us to efficiently manage a cash pool as well. And an investment pool, if we were looking at implementing that in addition to just cash pooling. The other key thing that allows us to do sort of on the debt side is issue any revolving lines of credit or intercompany loans between the corporate authority and any of our particular business units or companies, or we can ultimately do it between business units. But because one of the other things in-house banking allows us to do is standardize the rates we're charging, as well as the general management of rate feed integration from things like Bloomberg or Reuters, it allows us to standardize everything that we're doing, especially from a corporate perspective. So you can really reduce the number of these intra-business unit loans and focus on loans from a main authority to a subsidiary. When we're talking about linking the nominal and physical, it's of course very important to have regional banking partners in specific areas. So we are looking at tying the notional in-house bank accounts, things that are specific to our overall IHB structure. We now start to look at shifting those specific currencies and areas to have a mirrored look at banking partners that really manage all of our fund transfers in particular regions. So on the left side, we really have those regional treasury centers and authorities managing any of our in-house banking accounts. But then, of course, what we were talking about with the current accounts and the linking of the in-house bank to physical transfers when it's required, it's very important to have those regional partners to effectively settle funds across all of our regions and currencies, as well as meet any required legal, tax, or operational obligation that we hold. It also allows us to limit the amount of international transfers or intra-bank transfers. We can consolidate more towards book transfers as well. So how do we go about designing an optimal in-house banking structure? We've talked about a lot of the key components, the things that are important to an IHB structure, but how do we really go about understanding how our organization is going to benefit from this, the things that we need, the things that we even want to really make this scalable and something that can be maintained for a long period of time to come. Our key aspects to design, some of the things that we talked about already, but very important to highlight because they truly are some of the greatest benefits that you can get, is our cash pooling. So not only does it allow us to do the things like facilitate additional loan creation for intercompany loans or revolvers, but it allows us just in general to have a better understanding and picture of where all our cash sits, what our liquidity looks like across business units, across different chart string combinations, anything that you can think of in terms of kind of slicing and dicing the way cash is currently residing in our organization really allows us to begin to do that with cash pooling and a look at our overall liquidity. Cash pooling, of course, sets up some of those loans, revolvers, and even short-term credit facilities that we talked about just previously. So it's optimizing your central loan authority and standardizing all of your terms and procedures so that no longer you have a lot of different paperwork to manage, a lot of different rates being charged to different areas. There's a key standardization that allows the international treasury team and even our corporate treasury to more effectively take a look at and manage all of our different intercompany loans and get a real picture of what's going on in terms of a lending facility from our either cash pool or our in-house bank here. The mirroring account structures we'll talk about in just a second. That is one of the new benefits that we haven't talked about yet, but allows us to really facilitate accounting in an effective way without having to go and book any additional entries. It automates it all for us. So when we're facilitating things like intercompany loans or cash pooling, not only do we get the accounting for the physical movement of cash, but we also get the accounting from the intercompany movement as well. So an incredible benefit in terms of automating accounting for all of our purposes there as well. Of course, we can always consider complementary functionality. One of the ones that I think should always be looked at and implemented with any IHB strategy is the utilization of multilateral netting. It's one of the best benefits that you can get in terms of reducing the number of transfers that are actually needed for origination or entered into our specific banking partners to remit funds. It greatly reduces fees and it allows better tracking of invoice settlement as well, because everything is managed through that in-house banking structure. We can see in real time sort of where in totality all of our invoices sit. We can see in particular if a company needs direct funding for invoice settlement, then would you look at that? We got our intercompany loan setup already configured under in-house banking as well. So it consolidates all that information and greatly facilitates better flows of processes and origination when required. With the key aspect of integrating with payments as another key advantage of in-house banking, setting up a treasury management system that can remit payments from the system itself is an incredible benefit when you look at IHB, because IHB can propose all of your direct settlements. It can propose any sort of, with multilateral netting, currency positions that need to be staked. So now we're talking about things like capturing effective FX deals, all because we have multilateral netting, external payment integration, and in-house banking all together in one. And of course, with payments, you also get that direct file reception and acknowledgements to really see not only within the investment pool where everything stands in sort of our internal cash position where everything stands, but now you also get the external information so you can run things like variance analysis, see what should have settled and might still be pending. So you get a better understanding of where things might head within the next couple hours for the organization as the bank continues to settle funds and where funding requirements might change or be needed in addition to normal circumstances. Some of the key benefits just around cash pools and cash pooling, some of the key differences. There are nominal pools. So those are the standardized operational currencies that we see globally, things like USD, our euros, or our Great British pounds. So nominal pools are more focused on actually pooling funds within the IHB. So we can see a daily position reflecting all of our cash needs of all of our participants, the organization as a whole. And we can do it in real time. We're not waiting on anything. We're not waiting for the bank to send us a statement file. We're not waiting on transactions to be settled and payment statuses to be updated. We can see, we get sort of a sense into the future where we're headed within the next 30 minutes, within the next couple of hours. It also allows us to interact and do any FX trading or hedging before it's actually needed. So we get a better risk management strategy, a better hedging strategy, because we have that real-time access to all of our currency needs, all of the particular settlements that might occur and invoices that might come through. So we have a really good picture of everything that's going on organizationally. Physical pools are really sort of what we think of in terms of our daily ZBA transfers being executed to move cash to a central disbursement account or an account with higher earnings credits for a banking organization that may offer that. It allows us to sort of standardize the physical movement of funds to accounts that are specific to banking needs, our banking partners, and material like that. So the physical pools are actually constituting that direct movement of funds. Systems, typically for our treasury management systems, they not only allow us to capture information if the bank is managing our ZBAs. So a lot of circumstances, particularly in the United States, banks offer ZBA processes that are managed on their end. But with a lot of the treasury management systems in particular that we work with here at Elire, we can automate sweep transfer technology for countries outside the US. So we can sort of zero out accounts for particular banks that don't offer that service to us. So again, allowing us a better picture of liquidity, movement of funds where they're needed. In particular, with in-house banking, we can project that well in advance of when the bank actually sends their final current day statement file. Entities in other currencies, particularly sometimes don't participate in those physical cash sweeps just to minimize local FX trades and the delivery of funds that are required. We can have quite a few diverse sets of funds between different banks and different currencies. So it's very important to sort of understand when the movement of funds to physical pools is required, like typically in the United States, or when maybe more nominal pools may best serve us. And they are a complementary strategy. So it's not one or the other. It's very much how do we utilize both to very effectively manage our two sides here, both internal and external. When we're looking at intercompany loans, we're looking at sort of short-term versus longer term in terms of the key breakouts. Short-term can even be automated and facilitated automatically through the use of what we call cash pooling terms. So these cash pooling terms for anyone with an outstanding balance that is within a date set that we define ourselves. So let's say somebody can be outstanding and charged a lower interest rate for 48 hours until they fund the particular account that's required to settle things, maybe through multilateral netting. So they have a standardized automated procedure that we're not having to click through. We're not having to say, oh, who's got a negative balance? They have to be funded in the intermediate future, and then maybe we'll have to switch it over to intercompany loans later. No longer is that the case with treasury management systems now and the effective implementation of complementary IHB structures. We can facilitate that automatically. So if anybody's negative for the a short-term configurable period of time, we have the capability to set rates automatically, and we can update them as rates change as well. So you can obviously tie them to things like rate indexes, Fed funds rate, LIBOR, as we shift away from LIBOR, of course, maybe Singapore overnight rate, Norway, really anything that we see fit for any of our particular regions. It allows us to do things in the short term as well as issue short-term loans if we need to. So we can define period of days, weeks, or months in those short-term loans. And we can facilitate interest transfers and settlements to and from the cash pool directly. So these interest transfers are incredibly important when we're thinking about facilitating either interbusiness unit loans or the ones between the corporate IHB and the individual loan recipient. Instead of having to track manually what a individual company might own. Instead, it can be pulled automatically. And if there are particular settlement terms, then those settlements can be facilitated for what we talked about a little bit at the top of the presentation, our payment on behalf of functionality that is really managed by the international treasury team. So we get this great dynamic combo of utilizing inherent system functionality and better visibility to all of our intercompany loan configuration on the short term. These structured regular deposits to the cash pool through all of our nominal or physical sweeps allows us to know as well what sort of liquidity we stand with, what we can really offer in terms of short-term funding. If we should change rates, if we should maybe facilitate a higher interest rate just based on available cash, we can do that as well. And then it allows us to set up very nicely to sort of take a shift and look at if we should institute a revolving credit facility for any particular company, or maybe even a periodic loan structure, so that we can structure all of these material items through the in-house bank to see what sort of position, not only in cash, that every company or business unit has, but what also their debt position is. What sort of ratio do they have in terms of debt to cash, or their quick ratio, or whatever you might want to slice it up into. The IHB is now telling us directly how well this particular business unit is performing in terms of excess of cash or increased debt funding requirements. The periodic loan creation and administration can also be done and facilitated through the same exact system that we're talking about. So you get this automated sort of flow of information from somebody who's maybe set up for short term, and then we need to ship that to a longer term intercompany periodic loan or even revolving credit facility. So that is a great benefit as well. We're not sort of changing things, writing all these amendments, tracking them in different spreadsheets. Instead, we're maybe amending the agreement. We're then attaching that as we shift or roll over the short term to a long-term loan. And all of that is done in system. So not only is it acting as a sort of system of record here, but we also have a document repository to track all of our shifts and changes in these particular loans as well. It also allows us to do things like floating interest rate terms. So we don't always have to standardize some interest rate. We can use floating terms based on our rate feed integration, or we could use fixed terms as well. So when we're talking about the mirrored account structure, this is more moving towards the accounting aspect. What's really the key accounting benefit from utilizing our in-house banking structure? So we've talked about all the sort of great benefits in terms of the functional needs and requirements. How are we now tracking all this information? What are some of the cool things that we can do to get our accounting in line for intercompany movement of funds, and then our external accounting for the movement of cash? So when we think about cash movement, of course, we have those physical payments or deposits, which are recorded at the bank side in the cash accounts. We know we're either moving cash in or we're moving cash out. So we're either always going to debit or credit our particular cash account on the accounting side for the bank account itself. On the flip side, though, that fund that may be deposited or paid is maybe being used for different purposes within the in-house bank that reflect maybe different clearing accounts, income distribution accounts, interest accruals, the entire gambit of accounting chart fields that we're talking about for all of the functional material that we've delivered. So anything from cash sweeps or loans or transfers can also be tracked on the in-house banking side. So we're getting this great accounting benefit of all of our intercompany transactions also being booked and posted. So we're not having to do a manual facilitation of any additional accounting entries. We're now getting these automatically, as well as our traditional automated payment accounting functionality. So that's really the great accounting benefit. That's what we're talking about when we're saying, this mirrored account structure, because we have our external accounts and our internal accounts. So we know from the external facilitated movement of funds externally where it's going, and because our internal accounts tracking on the mirrored side, the internal movement of funds, we can see now that we can track accounting for both those ends. One of the key benefits always when we're talking about IHB is, of course, multilateral netting. So implementing either bilateral or multilateral netting in tandem with IHB allows us to do so many great additional things for invoices, for payables, for settlement of funds. So we're talking here about direct invoice financing and facilitating all those loans based upon the particular invoice requirements. And we're also reducing the amount of physical transactions that either need to be pursued externally or through the in-house bank as a whole. It gives us a lot of transparency and direct access to all of our settlement information, whether it's in the nominal or physical sides, or whether it's hitting a cash pool or a ZBA account. And then allows us to see information available to IHB positions and balances. So multilateral netting, very useful both for extremely large international organizations and then for smaller organizations as well that are doing a lot of intra-business unit invoicing and financing. So again, we're getting that enhanced cash position view, not just a reduction in the amount of transfers we're making. So incredible benefit to go along with the ones that we just talked about in terms of the accounting and the payment facilitation as well. What are some of the cornerstones for our IHB implementations? What are some of the things that we really look for organizations of all sizes when we're looking at implementing an IHB? So when we're looking at that implementation side, our essential considerations really boil down to a couple of key things. A lot of times there are going to be some policy changes that we need to keep in mind. So corporate might need to revise internal agreements to allow sweeps or ZBAs, especially when we're talking about facilitating those through a treasury management system. But even with banking partners, sometimes those agreements need to be amended and changed. So it's very important to look at that so that we can facilitate all of our cash pooling activity. Maybe our new policy redefines minimum operating cash in our cash sweeps for our business units. So maybe we need to hold minimum account balances somewhere. These policy changes really outline how we should structure our cash pooling terms, our ZBA movement of funds, sort of what balances need to be held where is an ultimate policy decision as well. A lot of the times too, we're changing investment policies a little bit. We're looking at maybe business unit to business unit intercompany loans or different facilities where we're really trying to standardize things. And that oftentimes boils down to writing policy considerations, outlining decisions as a key component of the project as a whole. With all of these policy changes, with all of this new functionality and all of this inherent benefit that can be distributed across the organization, there are often times where we need to look at the requirements for our existing resources. We need to take a look and see who's going to be taking on the responsibility, who's going to be the key benefactors of looking at our internal cash position, making sure that they have access to be able to view all the material that they need, and making sure that we build it in a way that's actually beneficial to their needs to make things like investment decisions and material around funding requirements. We also need to understand if there are operational requirements across time zones. So facilitating everything through an IHB in Europe might not be the most beneficial thing for business units that have essential operations in California or on the eastern seaboard of China. We need to understand sort of how we can facilitate based upon those time zone differences and really consolidate all of the functionality that we need to that international treasury team in a way that works best for everybody. When we look at the other side, maybe the little bit of a harder side, we talked about the softer skills, softer benefits. We're looking at things like bank account location. So implementing global sweeps, do we need additional accounts? Do we need additional banking partners? Are there particular things that require changes in bank accounts and bank account material? And we need to strategically open those offices and open those places and banking relationships and accounts in a way that will resolve any time zone issues that we talked about with some of the changes in resource requirements and different changes in areas to make it more compatible with the overall structure and needs and requirements of the organization as a whole. So that leads into our credit arrangements, both internal and external. We've set up all of our bank account relationships. We know what resources are managing what. We know sort of the policies that are laid out overall for ZBA structures, intercompany loans, and material like that. Well, how are we defining our credit arrangements now? Are we doing any intraday credit for our business units? Are we making sure that they get that intraday funding that's required? Usually the obvious answer is going to be yes. So making sure that we understand what all that entails, how quickly we can move funds. We have to have those bank account locations in place to be able to facilitate the actual movement of funds for operational needs, right? So that is a very key component once we've talked through these other core considerations. We also have to do a lot of the facilitation of all of our short-term liquidity facilities. What sort of balances should we hold? What sort of balances look good to move to things like pooled investing and additional investment purchases in regions for the organization and the participating business units as a whole. So a lot of things to consider specifically around our credit arrangements. The thing that goes along with the funding for credit arrangements and the cash pools and making sure that we actually have access to things that the business units require. So all of the particular funds that they need, all of the particular needs that they have for their operations. We're looking at our sweep and bank account structure. Who's physically sweeping? Who's nominal? What's the frequency? What are the balance requirements? Where are we looking at in terms of those cash pooling movement of funds? So all cash above a targeted balance is typically swept into a pool. When we're talking about keeping a minimum balance somewhere, it's not just ZBAs. And a lot of times too, we'll have to facilitate this for many different currencies. We'll have to look at currency positions, and we'll have to see what sort of entities have particular issues with non-functional currencies. Maybe we're holding more of a small balance regional currency that's only particular to an individual organizational business unit or company within our structure as a whole. So obviously we don't want to facilitate the movement of funds for that. They're the only particular interested player that desires those funds or might need them. So that's particular and outlining sort of our ZBA sweep structure, thing like that. Then of course we need to have that multilateral netting architecture in place too. So who is the netting authority? Where does the netting authority reside? What's the company? Is it linked directly to the in-house bank? Is it all pursuing intercompany settlements of funds, or are there direct physical settlements under particular circumstances? And outlining sort of the netting requirements, whether it's LIFO or FIFO for our actual netting invoice is important to define as well. So we have to understand what the overall account architecture is for netting here. And this can allow us to generate a lot of available review of information. So not only are we sort of defining all those policies, but when we encounter new netting cycles or we roll through netting cycles, it allows everybody to take a look at their invoice positions and what they're going to have to settle, or they might need funding for from a intercompany loan perspective in a more efficient and facilitated manner, and takes those invoices and standardizes them to the in-house banking architecture as a whole. With that, what are some of the key implementation strategies? What are really the essential strategies that we look at when we go to implement an IHB? We've talked a lot about sort of the different benefits or different areas that we focus in, but what do we really need to establish a sufficient in-house banking strategy? Usually there are going to be two in-house banks. I will say the shift has been more towards one in recent years, but typically two, one particular to the US, one particular to the rest of the world, since the US utilizes a lot of those physical cash sweeping structures, can be used. But typically, you know, we'll also see one in-house bank that's really being utilized at a global level for the organization as a whole. Particularly Europe, Luxembourg, Netherlands are the most attractive for in-house bank setup. And typically those will hold our key functional currencies like USD and Euro. And of course, all legal authorities and tax authorities within the organization need to be consulted when looking at setting up in-house banking. Maybe there are particular legal requirements that dictate that we either need one or two in-house banks. IHB pool structures are also important to note. So the IHB may be directly settles in USD and Euro, but do we have cash pool structures that are set up for maybe our Euro, US dollar, Great British Pound? Those are typically the standards. So we'll see cash pools there, but maybe we have a particularly high quantity of entities in Japan or Canada or even South Africa. Then we can establish regional currency requirements. Typically, internal accounts are going to be created for each entity as well, whether they're a high-level participant who's also utilizing multilateral netting or not. We'll typically establish an internal account for each entity within the organization. It's established within the local currency. For the most part, we'll also have those direct settlement accounts for IHB if we're looking at settling in our standardized operational currencies like USD and Euro. A lot of times these individual entities, when we set up the internal accounts, because we're now looking at either the established local currency or the standardized USD or Euro, they can transact now in multiple currencies. So they might have standard credit arrangements in one currency, but maybe facilitate invoice payment in another through multilateral netting. So now we can see that there's a standardized facilitation of fund transfers regardless of currency. And then we have to, of course, establish all of our lending and transaction rules. What sort of timeframes are we looking at? That has to be done as well. We have to make sure that we are abiding by, again, legal regulations as well as tax regulations for our specific lending between business units, and particularly when we're talking about more of our global organizations. We really have to take a closer look there as well. When we have all that in place, when we have a key look at all of our governance and our structures and processes, we've established now sort of our multilateral netting procedure and processes. We can now transact any currency settlements. We can do things like implement our trade structures. And again, it outlines all of this accounting that we need to post. So we no longer have accounting hounding us as treasurers to make sure that we get the accounting in, that it looks right. It's done automatically through the IHB. So it's an incredible benefit to not only the treasurers, but the accountants as well, because now they're getting their entries posted automatically on a regular standardized basis. And it allows us to maintain all this information regardless if it's for domestic cash positioning. So we just want to look at all of our particular business units in the US, where their cash sits, what sort of funding requirements that they might have, that it goes beyond just a bank account view. It allows us to take a look at that, but it also allows us to take a look at all of the things that we've just talked about within the last hour. That really gives us this clear organizational insight and overview into what really is going on inside the company. For the most part, as treasurers, we always have a really good grasp on where cash sits within our bank accounts, what sort of investments can we pursue based upon our liquidity levels, what sort of debt financing we might need, or any hedges that we might need. But this gives us such a more in-depth view and allows us to facilitate so much more effective movement of funds for the organization, that it is just one of the most key quintessential things that I can think of when I think of a real overarching, well-implemented treasury management system. So what are the key benefits? What's really come out of all of this particular material? The key benefits, we've talked about them at a high level, and we'll kind of recap what they particularly are here. So cash sweeps are an incredible benefit just to the particular structure of the organization as a whole. We standardize all of our depository regulations. What sort of balances do we need to hold where? We have all of our interest rate standardization and integration from all of our partners, whether it be from Bloomberg or Reuters for particular rate feed sources, and whether it's for currency or for interest rates, we now have everything standardized across the board. our intercompany loans that we talked about, whether they're the corporate to intercompany long-term loans or revolving credit facilities, or maybe they're the overnight intraday short-term credit facilities that need to be set up for funding requirements in direct needs and management. We can also set internal credit lines and limits. So we talked about that a little bit with the revolving credit facilities, but being able to set those limits for any of our particular partners is, again, a huge benefit as well. This automates all of our interest rate calculation, all of the pooled interest that should be distributed and dispersed to anybody participating in the cash pool or investment pool. Anybody whose funds were used for the issuance of loans, we can now track all of that and disperse it to all of our partners automatically. And with all that too, everything that we've transacted within our treasury management system allows us to generate accounting for it. So we're tracking everything in real time, posting to our subledger and then the GL on a regular, recurring, usually nightly basis for all of our activity that we're pursuing within the in-house bank itself. So a lot of really core key benefits here across the board. And with that, I will go ahead and turn it over to Jordan for some final remarks here, and then we will launch into some Q&A.
Thank you, Dayton. Yep, just a couple quick reminders here. So session recordings will be available at the end of next week. They will be password protected though, so make sure to check your email for our follow-up email that has the password in there. The sessions that are available for CTP credits do have those assessments. I know many attendees have already been taking them. They've been sent out in individual emails, but we will have those links still available through the end of next week in case you didn't get to attend a session or want to still take the exam. Scores are posted for the first two sessions from yesterday, so 80% pass rate or higher will have certificates that go out next week. If you didn't pass, again, you do have a chance to take it again. Also, just a last reminder to post on LinkedIn and Twitter with hashtag ETE 2021. We'd love to hear what your favorite session was or which session you enjoyed, or just anything in general about the conference. And we'll be doing some gift card drawings and swag giveaways once we take a look in the next couple of days here. And then lastly, we are going to have a post-conference attendee survey. We would love your honest feedback on how the conference went, if you have any topic ideas for next year, etc. Next year, we will also be opening up some treasury sessions to non-Elire and partner vendors as well. So if you're interested in presenting, please reach out and let us know. With that, we can move into the Q&A. There are a couple that came in here. First question, Dayton, is do you see many clients using IHB to facilitate a large intercompany notes portfolio? For example, 300 plus notes.
I do. I think we have seen quite a bit movement of notes, bills, bonds, all sorts of organizations facilitating intercompany, not only management of information for all of those notes, but any facilitation of direct settlement as well. I think it's one of the key benefits being able to house all that particular information in a single system that also gives the ability to remit any payments to our intercompanies as well.
Excellent. And one more, would virtual accounts be needed or popular with IHB?
They are. We do see virtual accounts pop up here and there, as well as virtual banks for different settlement purposes and the facilitation of different areas. I will say typically they're more of an exception than the norm. The typical intercompany account structure now that's been developed in particular with the facilitation of the material that we talked about today, the need for those virtual accounts that don't have direct settlement links is getting fewer and farther between, but we definitely see them pop up. They're definitely considered in pretty much every implementation we go through, and we just make sure the ones that are needed are well recorded, well vetted, and we know that the purpose and need, and that's well documented as well.
Excellent. It doesn't look like, oh, just kidding. We just got one extra question. Do you see many real estate customers using IHB given their complicated account structure?
We do. I think real estate companies in particular have been growing users of IHB over the last few years. We've done a few real estate implementations here at Elire for IHB implementations as well. So I think we do see a diversified set of real estate customers pursuing IHB strategies and implementing them to really facilitate that, a complicated account and business unit structure.
And then there's one more in here too. So it says true or false, Kyriba does not have POBO functionality in their IHB module.
True or false? They do have payment on behalf of. You can facilitate that within Kyriba. Kyriba, though, there is a little bit of considerations that go into that. I wouldn't say it's just as straightforward as being able to do it and then letting you run with it, but you can set it up for a IHB governance structure to be able to manage some of that material.
And we have time, it looks like, for one more here. If there are any additional questions, feel free to keep submitting them and we can follow up after the presentation. But our last question that we'll do live, is the streamlined accounting successful with a parent with many subsidiaries on different ERP platforms?
There are definitely some that are better than others. I will say that blatantly. There are certain systems like Kyriba that allow us to do a parent company, intercompany account relationship structure. So we sort of have the facilitation of this general hierarchy that looks a little cleaner and nicer. There are definitely some platforms that are not quite as good at tracking that information. But again, there are some great ones out there. It boils down to the consideration and the needs of your particular organization. But yeah, I think Kyriba is one of the best ones in that space.
Thank you, Dayton. With that, we are going to go ahead and wrap up our final session of ETE 2021. If you have any questions, please email the ETE2021@elire.com email address, or I think most attendees have my email as well. And we hope to see everyone next year. Thank you.